Why converting all your pre-tax retirement accounts to a Roth might be a big mistake. Roth conversions can be a powerful tax planning tool, but like any tool, using it the wrong way can do more harm than good. One of the most common mistakes we see is the idea that you should convert all of your pre-tax retirement savings, like a traditional IRA or 401k, to a Roth account. Everyone loves the idea of a tax-free retirement. When you convert money from a traditional IRA to a Roth IRA, you're moving it from a tax-deferred account to a tax-free account, but there's a price. The converted amount is considered income, and you must pay ordinary income tax in the year of the conversion. Once converted, funds grow tax-free. The best way to think about money in a pre-tax account is that it is deferred income. It will be taxed, it's just a matter of when. When you make contributions to a pre-tax account, you are not receiving a tax deduction, you are deferring income to a future year. When performing a Roth conversion, you are voluntarily deciding to pay tax on that income, even though you don't have to yet. This only makes sense if you are able to convert at a lower tax rate than you would otherwise be subject to if you decided not to convert. This most commonly happens between the beginning of retirement, typically in your 60s, and the beginning of your required distributions at age 75. During that period, taxable income is generally lower, which means conversions may be done at a lower tax rate than it will be after required distributions begin at 75. Required distributions can be a problem because if you have too much in pre-tax accounts, your required taxable distributions may push you into a higher tax bracket and trigger IRMAA. Roth conversions help this by shifting from pre-tax to tax-free, therefore reducing the level of taxable required distributions beginning at 75. However, there is an efficient amount that should be converted for every person. Converting 100% of pre-tax funds means you will likely be in a lower tax bracket after the conversions and will potentially not have any tax liability at all. This doesn't sound bad, but it means you likely paid too much in tax to convert the funds in the first place. Again, money in a pre-tax account is deferred income that will be taxed. The goal is to have that income taxed at the lowest tax rate possible. If you convert too aggressively, you may be settling for a higher tax rate on the money coming out and then not receiving enough tax-free income from the Roth account to justify it. Instead, structuring withdrawals and conversions to keep your taxable income consistently low all through retirement will result in a higher level of after-tax income. I'm Harrison Johnson with Wilsey Asset Management. If you like these videos, be sure to give it a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.